Welcome to the Perkins Coie Emerging Companies video seminar series. This is our sixth and final video discussing the 6 steps necessary to get an emerging company off the ground. I'm Buddy Arnheim, and I'm going to talk about seed funding. But before we jump into the substance, let me first give you a little background on Perkins Coie. Perkins Coie is an AmLaw 100 law firm with approximately 700 lawyers in 13 offices throughout the United States and 2 offices in China. Again, my name is Buddy Arnheim. I'm the chairman of our Emerging Companies Specialty Group, which is a group of approximately 80 lawyers in our firm who spend most, if not all, of their time working with emerging companies. And just for clarity, emerging companies in our mind are companies that are pursuing perishable market opportunities. They tend to have several characteristics in common. First, they're very fast growing in order to take advantage of that perishable market opportunity. Second, they typically fund their initial product development and market entry with external capital, oftentimes venture capital. And last, they tend to be built around 2 core assets: human capital moving the business forward, and intellectual property around which the business is being built. Let's talk about seed funding, and I'm not going to be able to touch on every element of seed funding, but I'm going to try to give you a highlight. I'm also not going to be talking about seed funding that comes from the government through grant money, or the very common use of Visa and MasterCard that by founders to sort of get the initial things going. But instead, I'm going to be talking about how investors typically infuse seed capital into a company. And generally speaking, they do it in 2 forms, either as a loan or the purchase of equity. When raising a modest amount of seed capital, and let me put modest at sub $1 million, there's a strong bias to do so in the form of a loan. It's a lot easier to memorialize, it's a lot less expensive to memorialize, and it can be implemented very, very quickly. The one important element, though, to think about in the receipt or the provision of a seed loan is that type of investment is fairly binary. If the company is unable to build value, it's very unlikely that any of the money will be repaid. And if the company is successful, most likely it's going to be successful in raising a larger round of financing, in which case the provision of the loan proceeds are likely to convert into that financing as opposed to be repaid. Oftentimes, institutional investors that would lead that next financing are averse to having a significant amount of their investment proceeds, funnel out of the company to pay off early loans. So, in all likelihood, the provision of a seed loan is the provision of money that the company uses to move itself forward and be able to raise a next round of capital in which the loan would be converted. The downside to an investor who is providing a seed loan is that the company is able to use that money, but the investor is not necessarily getting the upside or the appreciation of the business for the use of that money. So the question is, what are the economics? What are the typical economics for the provision of a seed loan by an investor? We often see these loans coupled with a modest amount of interest. And the lenders are typically not necessarily providing the loan for interest, but instead they're looking for some piece of the company. And so these loans are typically coupled with either a conversion discount or warrant coverage. And I would generally say that if the amount of proceeds being raised is sub $500,000 or even sub $1 million, structuring a warrant may not be in the company's or the lender's best interest because it's an actual legal document. It requires more legal fees. It's a little bit more complicated, and it adds cost and time to the provision of the seed loan. But let me talk a little bit about what the conversion discount would look like and what the warrant would look like. Typically, the conversion discount is a discount at which the principal and interest on the loan will convert into the next round of funding. And depending on the risk profile of the business, the risk profile of raising that next round of funding, the duration that the loan will be used before that loan is converted, the conversion discount will be set. We often see that if the seed loan is going to be outstanding 3 to 6 months, that the conversion discount tends to be something between, let's say, 20 and 30% of the price to be paid at that next round by the investors. Warrants tend to have a similar percentage, and warrants specifically are the right to buy stock, either common stock or the stock sold in the next financing, at some agreed upon price. Sometimes it's a nominal price, sometimes it's the price paid in the next round, or something in between. And the amount of shares, or the amount of warrant coverage, tends to be calculated by taking a percentage of the principal lent. So when somebody says 20% warrant coverage, they're saying take the principal lent, times that by 20%, and then divide that number by a certain agreed upon per share price, usually the price paid in the next round of financing, to come up with the number of shares. And then the cost of those shares is a negotiated element. It could be 1 cent, or it could be the price paid in the next financing, or something in between. In addition to these economic terms for bridge funding, there's oftentimes some discussion about whether there should be a security interest or a collateralized account. But again, when seed funding an emerging company, there's rarely anything there of value unless the company is able to raise more financing in the future. Thus, we tend to not spend that much time on the downside protection that we would typically spend in a more traditional loan. There also is oftentimes some discussion about information rights, control mechanisms. Lenders tend to want some information about the company so they can monitor the investment. I don't think that's an unreasonable request. But the question is how much information and at what intervals. And there's oftentimes discussion around control. Are there some restrictions on what the company can do with this money? Are there some restrictions on the company's operations that need to be cleared by the lenders? And that's up for negotiation. Generally, we don't see a lot of control mechanisms affixed to the provision of seed loans of modest amount. The final thing that I want to make sure that you're aware of when contemplating a seed loan into an emerging company is what happens if the company is acquired before the next round of financing, or what happens if the company is able to generate cash flow and not need that next round of funding? What kind of economic benefits should be paid out to the lenders? Oftentimes in the change of control scenario where the company is acquired before the next round of financing, we'll see the company provide a bonus payment or a premium payment to the lenders equal to 1 to 2x the principal lent. And there's no hard and fast rule there. It's oftentimes negotiated. But the concept is that these lenders provided capital at the most risky time in the company's life. There was a change of control. They should get some upside on that investment. And oftentimes, the providers of these seed loans tend to be people that the founders want to have a long-term relationship or already have a long-term relationship with, and tend to want to treat them very generously if that scenario unfolds. In the context where the company generates cash flow before it raises an external round of financing, and thus doesn't need to raise any additional funding, there tends to be a comparable premium payment that's made out to the lenders. It's usually done over time as opposed to one lump sum. But again, the concept is to treat the lenders who were very willing to absorb an enormous amount of risk by providing the initial capital an attractive return. That's the provision of a seed loan.